Hello and welcome to the stock specific class here for Thursday, October the 6th. If you have any questions during the week or any questions that I don't answer or get to in the live class, make sure you send those to Jerry at traderspro.com. I'll be happy to answer those for you. Just a note on that, though, that I usually answer emails in the evenings. So, if you're looking for an immediate response, chances are I won't be able to respond immediately. I try sometimes to check in during the day, so there's an odd chance that sometimes I can answer something a little bit sooner, but I usually schedule that time in the evenings so I can, I have the time to give good answers. During the market day, it can be kind of chaotic and I don't have the time to really give you a long, especially if you need a longer answer. It's harder to give a longer answer during that period of time. So usually I'll do it in the evenings. All right, let's get started. The price action over the last couple of days has been showing a little bit more of buying exhaustion. Now, we'll look at the chart here in just a second. Now, the important thing to point out about that is that it doesn't necessarily mean that the market's going to reverse and go down just because the buying is kind of drying up a little bit. I think it has more to do with the market behavior lately, which is to focus on the next event. As soon as we have an event that deals with inflation or deals with what the Fed might do, the market immediately focuses on the next event. We had a Fed meeting a couple weeks ago. After that Fed meeting, now this week, everyone's focused on tomorrow's jobs report, and the market's going to react to that. So the buying exhaustion pattern that I'm seeing could just be a pause to wait for that news to come out, and then we could see the buying continue. We could see the market still continue to move a little bit higher. And it would make sense when I get the charts, I'll point this out. It would make sense because where we're at right now, there's really not any reason for the market to turn around right here. There's no significant resistance area. Doesn't mean it can't, because sometimes markets will reverse when they reverse, and then it'll create a significant spot for the future. But you have to kind of factor that in and I'll show you, like I said, what I'm talking about when we get to the chart. But quickly over the direction alerts, not much has changed except that we do have our breadth indicator working again. Momentum, though, is right in the middle. Again, it could go either way. It just tells me that the market is off of that oversold condition it was in, and it moved off of it pretty quickly with that 2-day rally. It just brought it right back off the extreme. Breadth is still kind of teetering on the high extreme range, but it's still in an area where it could go either way. But definitely, I think we're seeing the weaker breadth because of the fact that there's that buying exhaustion. There's not many stocks doing a whole lot right now. A lot of lighter volume trading, and it just points to the market waiting for that jobs report tomorrow. And so I really think that's going to be the thing that gets the market moving again. Sentiment is still high, moved back into the extreme complacency range. The buy-sell ratios, this indicator was off, remember, on Tuesday. Remember, it had it slammed all the way down. One day it went from all the way up here down to here. Although it has dropped dramatically still, it's you can tell right here it's alleviated that extreme oversold condition a little bit, and if we continue to rally higher, that'll continue to close that gap and could even cross the lines there a little bit. This other sentiment indicator is again off the extremes, kind of not quite in the middle, but in an area where we could go either way. It's not overbought or oversold. And again, that's what these early indicators are telling us, is basically just overbought, oversold. Is the market getting into extremely stretched area, gone up too far too fast, gone down too far too fast, and then we take that information into our chart observations, and if the market's been moving up, but it's in an extremely overbought condition, the chances of it moving higher without a correction of some sort or without moving sideways to alleviate that overbought condition is pretty low. So you wouldn't want to be buying or doing too much heavy buying into that market condition. You'd want to wait for the market to maybe pull back a little bit. In a bull market, you'd want to wait for the market to pull back a little bit. In a bear market, bear market, you're going to be mostly sitting in cash and waiting for the downtrend to end before you start deploying too much. But in an uptrend, you'd be waiting for that to buy the pullbacks, buy the dip, so to speak. All right. I've been checking on this index tab quite a bit to look at the buy-sell ratios here. They've come up a little bit. There's still a lot of sells compared to buys, but they're not quite as oversold as they were, last week when we were in that decline. You can see that there's still, out of the Russell 3000, there's still a lot of stocks in the sell area, but look at the majority are in the middle, and we've seen the buys start to pick up. Remember, this was just double digits last week, so there's on this just 2-day rally early in this week, we've seen that alleviate that condition a little bit. Now, this is not something you have to check on every day. I'm just pointing it out because just to show you how we were in that extreme range. It told us when we were in that extreme oversold range, it told us that there's a chance that we could get this snapback rally, and there's a pretty good probability we're in a position where we get a snapback rally. We did, and so you go through this a few times, and you see it kind of play out, and it gives you a little bit more confidence in what you're looking at and how to use the software to help in making some of those decisions. All right, let's get to the charts. And I'll show you what I'm talking about as far as buying exhaustion. Because anytime you see this, this is what it's telling you. And it needs confirmation, but it can kind of warn you, especially if you see it on an individual stock and there's not, like I said, right now there's a market event that's about to take place. So a lot of individual stocks have this exact pattern, and it's all going to be tied to this event tomorrow. And so it doesn't. You definitely would want to wait for confirmation before reacting to it. But it is a bearish signal. But it, like I said, needs confirmation. When I talk about bearish reversal candles, this is not necessarily a bearish reversal candle that you would trade off of. You need to wait for the next day. And I'll tell you what you would look for as we look at this right here as confirmation. So what we have is we had Monday's big rally right here, and then we had the big move up on Tuesday. And here's where we closed. We closed right at the highs of the day on Tuesday. Yesterday, we opened lower, so the market dropped at the open, and then it managed to rally back up. And typically in a strong buying exhaustion candle, you wouldn't go higher than the previous day's high. So we wouldn't have gone above this high. Usually you're going to close right at it. Now, if you do see that is a very strong buying exhaustion signal that the stock could not go higher than that previous day's high. It opened lower that day, tried to rally back up, but it couldn't close higher. It couldn't close higher than it did the day before. Again, if you think about it, just think about someone that's trying to they're in a marathon and they're slowing down as they're tired, but then they try to get their energy back and sprint one more time, but it's like their last bit of energy. Once that's done, what happens? They collapse, and in this case, you'd see the stock typically collapse in this situation. Now, again, the textbook exhaustion pattern is that it would go exactly to the high, not above it. I'm telling you though, if you stick by that exact definition, you're hardly ever gonna find trades based off of it, or you know, it's with a lot of things in trading. It's like with Elliott wave analysis. There's some things in Elliott wave analysis, and I've met people that are Elliott wave fanatics, and they believe that that everything has to be exact, or that Elliott wave is going to perfectly predict anything that happens, and it's just never been my experience that anything can perfectly predict what happens. You have to take a little bit more of a general look to it. You can't be too strict with things when it comes to technical analysis in the markets, because there's emotions involved, and there can be these little emotional swings that cause you to move a little bit beyond some of these textbook definitions. And so what we did yesterday, we barely moved above that high. And this was all during the last hour, I believe, that we moved above that high, and then we faded into the close. We faded back below that high. So this is signaling that buying exhaustion. So anytime you see that, that's buying exhaustion. If you see the opposite of that, I don't see an example here that I could show you, but the opposite of that would be selling exhaustion, where you're dropping down, you drop down, you have a big down day or a decent down day, and then you have another day where it gaps up, it tries to gap up, and then it sails off, comes right back down to the close, but doesn't go lower. These would be red candles. Typically that's showing selling exhaustion, and that you might start to see buyers start stepping in and pushing things higher. Now, the confirmation that I look for is a close below the low of the previous day. So if for instance today, although again, I don't think it will because of the event tomorrow, and even if it does, I don't know that I would fully trust it because I know the market's focused on that event. But let's say there's no event tomorrow, and let's say that the market were to drop into the close and we close below yesterday's low. That would be a signal that we're probably going to move down the next day. Now, these candle formations are very short term in nature. They're not necessarily going to tell you, what's going to happen over the next several days. They're just telling you what can happen possibly in the next day or two. But if you combine that with the fact that we're in a downtrend, lower highs, lower lows, this could be another lower high. We just had a market that broke the June lows on Friday. You get buying exhaustion and a bearish confirmation. Again, that's all you get in trading is these things line up, and there's a high probability that this thing is going to go down the next day. And in the context, you would say it could go down the next day and probably go down to a lower low, continue to move lower. This could be the start of another move down. So this is how you can kind of combine those shorter term candle formations with the longer term trend analysis to make yourself look pretty smart sometimes. Sometimes it doesn't always work out, but that's the best you can do. You line those probabilities up in your favor, and then you manage it. You know, if you're wrong, you shouldn't go back above this area here, because this is where the buyers stop buying. So you put your stop up here if you're shorting the stock. And if it rolls, if it doesn't go down, it comes right back up again. Then you get out, you lose a little bit. You risk this much. If you're wrong, you could gain this much if you're right. And that's trading in a nutshell right there. That's what you're trying to accomplish, is to set yourself up with situations where you can make more money if you're right than lose when you're wrong. So anyway, and in the case of that bearish pattern of showing it selling exhaustion, you would look for a close above the high of the previous day. So you'd want an up day that closes above this high, and then that could tell you it's more likely to move up, or at least for the next day or so, move up in that direction. Now, again, just these pauses and these showing buying exhaustion doesn't always mean that it's going to reverse immediately. Sometimes what will happen, and usually these are stronger in a at the end of an upward move. That's why I'm also more skeptical right here. Is we only had a 2-day rally off of this, but you can kind of see it right up and through here. We had a decent rally up into here, and then it just couldn't go any higher. The buyers couldn't really push anything higher, and then it dropped. But sometimes it can be a pause. It could just be showing a pause. You might go up another day or two, and then it reverses. It was showing you that there weren't a lot of buyers there, but then there's that somebody found that last bit of energy to run a little bit longer before they collapsed, and then it drops. So more importantly here, I'm trying to help you understand how to read it's all about momentum and how to read what the momentum is, be able to recognize a momentum shift. I talk about this all the time when I teach candlesticks is that my wife, she doesn't understand in the middle of the football game, my team could be winning and our quarterback throws an interception, at a key spot on the field, and I'm freaking out and I'm worried, and she doesn't understand because my team's winning. Why are you so upset? Your team's winning. Well, because I recognized a huge momentum shift that could mean that my team might lose, and I'm recognizing that. Now, momentum is hard to quantify. You can't. There's not necessarily a mathematical calculation for it, but there are behaviors or things that can happen that if you know what you're looking for, you can recognize that momentum change. And if you understand football and you understand what a turnover can mean at a certain area on the field, you recognize immediately that that's not good, or that momentum is shifting. And that's what we're trying to do with these stocks is can I recognize these little patterns that take place, or this little behavior that takes place that can warn me that there could be a shift or a change in momentum. Now that shift in momentum, that change in momentum could happen very dramatically tomorrow with that jobs report. But the other thing too was that, and I think I pointed this out on Tuesday, but it's worth going over again, that with the next kind of resistance here, where if we do rally up, where do we have to watch for? What level do we need to watch? And it would be right in this area, kind of right through here. And it's kind of right. It's if you want a number, I think we talked about it being 389. Is that right? 380. I believe it's right at that 389 level. You've got support there, resistance here, support here, resistance here. And you can see we're kind of in no man's land right here. If I draw a line straight across right here, I don't see anything really. I mean, here it kind of paused a little bit before going lower, but that's not real strong resistance. So now again, it depends on if this is where when people say, well, when I'm watching jobs reports, if you don't know, the jobs report comes out the first Friday of every month. And so you say, well, how do I trade that? If the jobs report is good, the market goes up. The jobs report is bad, the market goes down. And that would be the logical way to look at it. But in trading, as I talk about all the time, it really depends on what the market is wanting or expecting. And there's a lot of times where bad news is good news and good news is bad news. And bad news is bad news and good news is good news. And it's crazy and it doesn't make a lot of sense, but it's just how the markets work. It's what creates the chaos of the markets. And what you have to, if you're just going off of charts, you don't really have to deal with this as much because you're not waiting for an event or a news. You're simply looking at what the chart behavior is and the direction. That's why you do want to put more emphasis on what the chart actually does as opposed to try to guess, what the Fed decision is going to mean. You could spend hours debating what you think the Fed decision means, whether it's bullish or bearish, and it won't matter because the only thing that matters is what the trading crowd out there decides and where they push the market. You could be convinced that the Fed is doing the right thing and the market should rally, but then the rest of the trading crowd could view it as being a negative and the market's going to drop. It doesn't matter how much you think you're right. The market's the movement of the market is ultimately right, and that's what we want to focus on. So I don't want you to get you off the focus of the charts and start paying attention to every jobs report that comes out from here on out. But you do need to be aware of some of these events because sometimes the market will focus on these events, and it is right now. It'll focus on these events. Now, the problem with these events right now, they're binary events. You're either going to see it move up or move down, and it could be big, and it's like you feel like you're flipping a coin. And that's what I feel like today. It's like, okay, I'm seeing buying exhaustion. I don't know what that jobs report is going to mean tomorrow. How do I'd be guessing if I'm trying to make a trade based off of it. Now, what I like is when the market starts moving and just it focuses less on the binary events. Now, it always focus on those events because that's what the fundamental traders always look for and look at. But what you hope for is that you don't get as big a reaction to where you can have a big move against you. Most jobs reports and most normal market conditions, you'll see a little bit of a reaction in the market, but usually it's going to continue to follow trend. You don't see too many trend reversals off of jobs reports. Usually you'll see little initial reaction that'll continue in the direction of the trend most of the time. Usually it takes a little bit more than just one jobs report to flip the trend. So another way to put it is, if it makes sense, is that sometimes the market is more focused on fundamental reasons, and sometimes the market focuses more on technical reasons for movements. And as a technical trader, it's going to be a little bit harder to be right when the market's focused on fundamental reasons. It's going to be a really easy, and it's going to feel like you're a genius when the market is focusing on technical things and it's moving in more of a technical fashion. That can be a little bit confusing, but at least for now, that's the best way I can kind of explain it. But so right where we're at right now, I would assume that so the market right now is actually focusing on bad news being good news. So if the jobs report, if there's a high unemployment rates rising, that's going to be good because that means what the Fed has been doing is working. It's slowing down the economy. It's hopefully going to bring inflation down because if people get laid off, they're not going to be able to. Well, it's sadistic. This is where the Fed is just they're in a no-win situation right now, because in order to bring down inflation, they've got to have people out of work, not spending money, which means pain, and it means pain for a lot of people out there. And it's not, this is the sadistic part of this too, is that the rich people, they'll have some pain. They might have to close one of their 10 businesses. But the people that really get hurt in these recessions are the poor and the people that need the income the most. They're talking about being able to just eat, not having to cut their fifth vacation of the year because they're in a slowdown. So it is we sometimes we talk about this stuff and you see the market wants to see that the jobs or the unemployment rate go up so the Fed will stop raising rates. So they're cheering for this event that's really going to cause a lot of pain for a lot of people. And it feels it just feels weird to do that. But that's what the market does sometimes, and that's what it's doing right now. And so that's what, if that number comes in kind of bad, that would be good. You'd see the market rally, but I don't think it's going to rally past this 389 area. Because again, what's going to happen is you're going to get that number, the market's going to react, and then it's immediately going to say, okay, when's the next Fed event? When's the next Fed meeting? And the next Fed meeting is next month. I think it's like the 2nd of November. Whatever that first Wednesday in November, whatever that is when the next Fed meeting is. And it'll immediately start focusing on that. Well, no, because there'll be a CPI number that'll come out, PPI number. CPI has been the big one that the markets focus on, but that'll be the next event that it'll kind of fixate on. So I don't know though. It's possible that it could break out above this level here. But remember, the reason why I came up with that level is we drew this trend line down. And we already pointed out the strong horizontal resistance in that area, a lot of market reactions in that area, but also this downtrend line right here. And if we blast through that, then we've got to be talking about potential for a actual trend reversal into an uptrend, which again could happen. And if it, we'll look to deal with that in the portfolio, maybe add a few more trades in there or something like that if that were to take place. But that's kind of the area there that I'd be looking at, is if we do blast higher, let's look at that 389 area to see if it stops right there or reverses right there or gives us a bearish reversal candle. I might have to jump back into some of those inverse ETFs that we've been using. I did get back into the SARK one just because, again, with that buying exhaustion showing up, there was selling exhaustion showing up on the SARK, and I wanted to hedge a little bit again, especially going to this jobs number where it could go either way. And if it does drop, I want to make sure we have something in there to hedge a little bit because I have a lot of long positions in there. So, all right, so that's what I'm going to be focused on. Now, again, what if we drop off of that report? Well, what you'd be looking for is, now today I don't expect much from today, but tomorrow, do we close below today's low? It wouldn't be hard to do that because it's a very compact day. In fact, you might even want to just, at this point, see if it can close below yesterday's low as just additional confirmation. If it can close below that tomorrow, then we're probably heading lower. Now, don't discount that break below that June low. The fact that we broke below that June low, we went to a lower low right there. Okay, that's basic trend analysis 101. It's very, sometimes it's easy to just discard that as, especially since it was just a one-day drop and then went right back above it. Just say, oh, this doesn't mean anything. No, this means something. This is one of the main reasons why I think this is just a rally within the downtrend, is that we did already break lower. We had that lower low. We're just looking for a lower high. Anything below this high would be a lower high. I just think that the most logical place for that lower high is going to be in this intersection of those trend lines. Okay. And I know those aren't great trend lines I drew, but I'm tired of drawing them, so I just wanted to draw them real quick there. All right, so that's what I'd be looking for this week. And again, I know I haven't been spending much time on the other index charts. It's because a lot of them have looked exactly the same and really haven't shown anything different, much different. Although I would say that there is one that has, which is the Russell 2000. The Russell 2000 was the only one that didn't go below the June lows. But there again, this is looking like a bearish ABC pattern on this chart. It has some. It's pretty close to its resistance. It doesn't have to go up much further to find its resistance. So what I would expect to see then is that the Russell, if there is a rally here tomorrow, that the Russell might actually underperform the other indexes, and that would kind of be a little bit of a bearish signal if it really bumps into this resistance and holds right there, because it will probably get there before the S&P gets to its resistance area. So it'll be interesting to see how that kind of plays out. But I've been skipping over these because most of them have been just showing. I'd be doing the exact same analysis on each of them, and it'd be kind of just wasting time. Let's take a look at bonds. Bonds are clearly in a downtrend. We talked about this on Tuesday that this looked like just another rally within the downtrend. This area right here is the key area. If we were talking about a possible trend reversal, that was the last significant lower high before the lower low that took place right here. The fact that we are already rolled over, I would assume that we're going to go to another lower low, although there's always a chance that you get that one more last push, wave A, wave B, wave C, and then it drops. But ultimately, the trend is down, and it's acting like it wants to continue to move down. By the way, if you're wanting to trade the bond movement, but you don't want to be shorting it like the TLT is going down, there is the TBT, which is the inverse of this, and so you could buy this. It doesn't, it's not going to. You can see this move from down here to down there. That's not too bad. A $2 move for that move. Remember, the SH was one that I would avoid because you'd have to get a huge move to get $1 move on it. You're just not going to make much money on that. But this is if you want to trade bonds, if you think that bond yields are going to continue to go higher. Now, keep in mind that this has really been in a long this is a long uptrend, but TLT has been in a long downtrend. It's probably getting closer to a bottom. Not yet. I don't know if it's there yet, but you might be a little late to be getting into that trend if you're going to trade this. Just be aware of that. But you can use this in the future. If you want to trade whatever the trend of bonds is, there's a way you can trade it both up or down without having to short it. So I just thought I'd bring that up. Gold, again, it had this nice sharp move. It's kind of paused the last couple of days here. It did manage to get above this area. We were right at it on oh wait, I guess we had broken above it on the last update on Tuesday there. We had broken above it. This is the last lower high or last significant lower high. You might want to see if we could break above that. I don't want to spend much time on gold though. Just like I said, it's been pretty erratic for the last little bit. Maybe someday we'll spend a little bit more time on it if it starts to move a little bit more predictably. Oil, though, has been trending up. We do have oil exposure in the portfolio, and it's really what's making us some money now. It's held up pretty well. I think that I think it's significant that we've kind of broken above this area right here. There's a lot of support there. There's some resistance right into here, and now we're getting back above that. Here was a lower high right there. Lower high, lower low. This is the last lower low, last significant lower high. So getting above here is the next step to show that this is a pretty bullish move. But overall, this is a pretty impulsive looking move. Now, what can confirm that is if you do see a down day in oil or a down few days in oil, does it pull back in more of a choppy fashion, more of a choppy or sideways fashion, kind of forming that ABC. If it does, that's a bullish sign as well, because you've got an impulsive down, impulsive up, and now you've got corrective. So stocks, when they're trending down, will have impulsive down, corrective as they try to rally, impulsive down, corrective. Usually in trend reversals, you get impulsive moves in the opposite direction, impulsive down, impulsive up. And then you see the behavior change. Now your pullbacks are more corrective or choppy. And that's typically how trends tend to move. Again, not always, but if you can, and you're not going to base your trade on that alone. And that's important with a lot of these things I talk about in this class. None of these, almost none of the things I talk about should ever be the primary reason for your decision. We're gathering clues. We want to gather as many clues as we can, and then we want to see how many of those clues are pointing to. Do we have a majority of the clues pointing to the market moving up? Do we have a majority pointing to the market moving down? Or do we have completely offsetting clues that tell us it could go either way and we don't want to do anything? We want to just sit tight. Remember, we've had some of those days where it's like, it's a coin flip here, go either way. I don't want to do anything in that type of condition. So it's really important that all these things that I'm teaching you are they're a lot of them are general, but they shouldn't be used exclusively in your decision. It's just recognizing the typical behavior of these charts, learning how they typically move. And well, any of you that are parents, you know a little. You've experienced this, especially if you've had multiple children. You know that you get to know their personalities, right? And you know, in a certain situation, you almost know what they're going to do, right? Because you know their behavior. You know that I know that my second son is very mischievous, and he's going to do. If I see him in a certain, this is when he was younger. If I saw him in a certain situation, I almost could tell you exactly what he was going to do. But it's because you recognize the behavior. It doesn't mean I can perfectly predict what he's going to do next, because I couldn't. Sometimes he would surprise me. But a lot of times it's like you feel like you know the future. I know. It's like, I used to use the example of the hot stove. My oldest son is very cautious. So he would be the one that would, if the stove was hot, he'd be the one that would tell everyone not to touch the stove, and he'd make sure nobody touched the stove. My second son, you tell him the stove is hot, and I know exactly what he's going to do. He's going to go over there to touch it and see if it's actually hot. He's going to burn his hand. I know he's going to do that, just because I know his behavior. So I didn't mean to get sidetracked on that, but that's kind of, I just want to try to bring in something that you might be able to relate to as it relates to the markets. This is what we're trying to do in the markets. We know we can't perfectly predict what's going to happen next, but there are times when we know there's a pretty good chance that stove is going to get the hot stove is going to get touched, and then we can manage that. We can manage the risk around that expectation. And so anyway, I just wanted to point that out, that's what I'd be looking for is on these pullbacks. Does it pull back in more of a choppy way? If it pulls back in a really sharp, impulsive way, then we're probably still in the downtrend. That put in a lower high. We're probably going to go to a lower low. It's still acting like the downtrend. Okay. Or it would be enough that would cause me to or it could create indecision. Maybe you get impulsive up and it looks like you're breaking out above these levels, and suddenly you get impulsive down and then you get impulsive up again. This thing, I can't read what it's doing, or I'm not comfortable with how it's behaving, so I should just back off. And let's not focus on this, because I can't tell how it's behaving right now. Is it behaving like it wants to go up or behaving like it wants to go down? And it's okay to do that. I think when we learn all this technical analysis stuff, we want to believe that we're always going to know what the trend direction is and what to do. And there are times where you should do nothing because the market's not telling you anything, at least not in a strong enough way that gives you an edge. And the better you can recognize that, the more likely you can get off on the sidelines, and wait, or just wait until that changes. And you'll find that a lot of times you won't go more than a week or so before it changes and it gives you a stronger direction. You can then go in and trade. So, but I think what causes people to lose a lot of money is because they don't know how to recognize these things. They overtrade in these indecision periods, and that's you probably find, if you look back, you probably find that those conditions were where you lost the most money, because for the most part you were guessing, and if you guess wrong, you could get burned. In some cases, burned pretty bad. All right, the dollar. We talked about how it pulled back right here. I mentioned that this looks like it could be a little bit of a bullish ABC pattern. We talked about how there's a little bit of support right here from this previous little pullback. This is a breakout area, so it pulled back and it broke out above that. It pulled back to it. Now it's starting to move back up. So it does, at least as of right now, it looks like that was a correction. The dollar's resuming its trend back up. That pullback remember, the dollar was all the way at the far left or far right side of that extreme range. It pushed us all the way back into here, and now it's now alleviated that overbought condition. And so now if the dollar does want to rally all the way back up, it's kind of free to do that. Can you trade something like that? Could we put on a trade on the dollar? And maybe we will. Let's go ahead and do that today. I have a couple I want to add. I don't want to add more than that. So I don't want to add this. I don't want to add this just yet, but that is something you could trade. You could put a stop down below here and see if the dollar continues to move up. Now, it might not be done correcting. Sometimes that could be just wave A, wave B, wave C. Another thing I mentioned was on Tuesday, I mentioned that there's probably stronger support right in here, because this was a much bigger correction back down. And then it hovered along here. It corrected sideways through here before breaking out. Dipped a little bit below there, but came right back up again. But this is probably a stronger support area. So maybe that is just wave A, wave B, and then you get wave C down to here, and then it trends up. So that's something to be aware of. All right, the VIX has been, it actually moved up a little bit today. It's not showing moving up very strongly here on the VIXY, but here, let me pull up the VIX on my other charting service. And the VIXY and the VIX don't always look the same, and they're not pegged to the same dollar amounts, but you can see it's moving up above 30 again. I think, again, that has a lot to do with the uncertainty of tomorrow. Traders are hedging a little bit ahead of that. I mean, that's kind of what I did. With buying the SARK, I'm hedging my portfolio. That's what these other fund managers are doing, but they're doing it with options, put options. They're buying protective puts, is what they're called. Those protective puts will go up in value if the market goes down in value. But getting back above 30 is the level of fear, not panic, but fear. So when we're above 30, the market is fearful. If we get above 40, that's the panic, above 40. And one of these days, I think on the next move down, I think we'll blast above that 40 level, but we'll see. We've been waiting on that for a long time now, talking about it for a long time. And sometimes that's what happens. All right. And other things we've been looking at, chip stocks. Now, the chip stocks have been participating with the rally. Now, this is a situation where, again, what we're looking for divergence. We're looking for, the chip stock should be leading the way. There are going to be days where it's doing exactly the same thing as the rest of the market. That rally off the lows looks the same as the rest of the market. I don't or you could even make the argument that it did close higher than the Tuesday move. It traded even higher today, so maybe it is outperforming a little bit in its own way. What would I look for as a divergence? Well, if the market went higher and chips went down, that would be very negative. That would warn me not to trust the rally. But there are some days where it's not telling me anything, and really, it's not telling me anything today except for it's just doing what the rest of the market's doing. So you got to be careful not to start nitpicking or looking too much into some of these charts. I talk about the VIX sometimes. Sometimes the VIX doesn't tell you something significant every day, and if you assume that it is, then sometimes you could be creating signals that aren't really there or aren't really that significant, and then adding significance to it in your head. And I think that could be dangerous. If you check these indicators, and again, most of the time they're just going to look the same as everything else, and you don't overanalyze them, then when they do behave differently, it jumps out, and then that's when it's significant. That's when you would want to really pay attention to it. If we had a big upward move in the market, we had a big bearish candle in chips, that would be a huge divergence, and I would say do not trust that rally. Doesn't mean I have to trade it, but I definitely wouldn't be buying into that trend if I saw that type of divergence with chips. Now, typically I'd be looking at, instead of the S&P, I'd be looking at the NASDAQ 100. I like to try to compare the movement of the chip stocks to the NASDAQ 100 because the majority of the NASDAQ 100 are tech companies which need chips. And that's why it's kind of viewed as a little bit of a leading indicator. Now, I am looking at entering into a chip stock today in the portfolio. I'll get to that here when we get to the stock-specific stuff. Question, should I be looking at the momentum data and what level before I can take on a long position? Well, you want to look at momentum as far as, are you in any of the market extremes? We're not in a market extreme right now, so you do want to factor that in, those direction alerts we went over in the beginning of class. And then you want to look at the overall market trend behavior, and that's what we're going through right now. Is we're trying to come to a conclusion what the behavior of the market is. I'll give you that kind of wrap up after all this analysis. And then, so basically though, right now we're in a bear market, in a bearish trend in the bear market, and we're looking at this rally is just a rally within the downtrend of a bear market. So with all that already known, you don't want to be adding too many long positions. Now, again, there are stocks that are trending up, that will trend up in a bear market. We're trying to find some of those, and I'll talk about some of those trades here in just a second as part of the specific stocks. But you wouldn't want to be getting into a ton of new trades. You want to be mostly in cash in this type of environment. You don't want to get wiped out in a bear market and then not have the money to make a ton of money when the market finally bottoms and starts to move back up. And really right now we're waiting for that bottoming behavior. We're not going to be able to pick the exact bottom, but we need to see some things that almost every market bottom the characteristics almost every market bottom has had in the history of the markets. We want to see some of that behavior to know that we're close. And then even then we'd want to see that trend the trend reversal starting to take place before we started to get to add more of the money in the portfolio to new trades. So hopefully that makes sense. And like I said, I'll kind of wrap all of our analysis up here in a second after we look at all these different things. I try to just kind of wrap it up here as to my conclusion, near term and longer term, and then we can decide, based off of that, what we want to do. So chip stocks, again, not telling us a ton. Same with transportation stocks. You've had the, kind of the buying exhaustion showing up right there, not really telling us much. Bitcoin has just been hovering right here, but again, it's still in this downtrend. I think it'll end up breaking this support area to the downside, but there's still some room where it could rally up to this trend line. I didn't draw that trend line very well. So if the market does rally off that jobs report, we could see the Bitcoin rally, but it'd probably rally right up into this area right here. And then you have to look to see if it rolls over at that point. All right. So, and the high yield corporate bonds, the market's been moving almost exactly with this chart. So it's not telling us anything different here. But it does have, it is right at significant resistance right now. There's a little bit of resistance just above it right here. So what I'd be looking for tomorrow is does the market break out and go higher on the jobs report, but this actually doesn't break out above here, or it reverses this? That could be a conflicting signal there that could indicate not to trust the rally there. All right. Bottom line, we're in a bear market. We're not in an overbought or oversold condition, so we can move either way right here. We could go up further, we could go down further. We're in a downtrend within a bear market, lower highs, lower lows. So you've got the longer trend down, you've even got the shorter trend, lower highs, lower lows right here down. We're rallied up a little bit right here. We pointed out that there's room for it to rally a little bit higher, but there's a lot of resistance up in here. And then it looks like more downside. The stronger probability is that we're heading lower. Now, again, what I would, if I'm looking at new trades, now, again, the whole point of having this class is to give you ideas. And obviously I have trades in the portfolio I'm already in. And really the only reason why I'm going to be adding something to it is because I'm getting stopped out of one of them, which I probably put my stop a little bit too tight on that one. But I notice how I'm going to be mostly in cash. I don't want to have too much of my overall portfolio in trades right now. But if you're in a situation where you don't have any trades and you're looking for ideas, I will point out some things you can consider that you might want to add to your portfolio. You're going to have to come up with your way to manage the trades, because I can't tell you specifically what to do, but you can use a trailing stop or look at the previous low to put your stop in, as I do a lot on a lot of these trades. But that'll give you some ideas. Now let's take a look at the trades I'm in first, and then we'll get into the specific stocks. All right, NOC. Again, this one's just been moving sideways, but I like the defensive stocks. I want to have some exposure to them. By the way, and again, I'm not basing my trades on fundamental reasons, but if I like some of the trend behavior and there's a good fundamental reason to believe it could go higher, then that works out pretty well. But I read an article last night about Taiwan and the dilemma that the U.S. and again, the part of me is very skeptical of this, because there's no way that the United States government is going to tell you that their strategy in the media so that China knows exactly what they're going to do. So I don't want to, that's why I'm not going to be basing a decision on this alone. But the concept made sense, and that was that they want to make sure that Taiwan has enough weapons in case China invades them. They've got to be able to hold out long enough until the U.S. could get involved to help them out. And because Taiwan is an island, the first thing that China is going to do is surround the island so that no supplies can get in. And so the article is saying that basically the focus right now is to start stockpiling these weapons in Taiwan so that they have, the ways to fight. Because we've been supplying Ukraine, but we're able to supply Ukraine because Russia can't. They're not in the countries that are to the west of Ukraine, so we're able to get the supplies in that way. Taiwan's a different problem. So anyway, my thought process after reading that article was, okay, it fits in with the whole argument that we want to own some of these defensive stocks because they're going to be making money. Not only is Taiwan going to be buying weapons, but everybody else that is surrounding Russia right now is realizing they might be undersupplied and they're going to be buying weapons. And then the U.S. has been supplying weapons. They got to replace those weapons. It just seems like a no-brainer that particularly some of these larger companies are going to make money for the next few years. Now, it can depend on how well those companies manage their business. You could sell a lot of things and be terrible managing your expenses and your costs and all that kind of stuff. So, but these companies have been run pretty well for a number of years, and so I would assume that they've got good management teams. But anyway, I want to have some exposure to defense. I've liked the chart of Northrop Grumman, but there are a couple other ones that I wouldn't buy them yet, but you definitely want to put them in your watch list. I'll go over those here in just a second. But Northrop is still looking fine. My stop, let me go back to that one. My stop is down below here. It's been moving mostly sideways, so it really hasn't done a ton for us yet. And it probably needs the market to start moving higher a little bit for it to start to take off. We added last week, I believe, or I think it was last week, I added Cheniere, which is a natural gas company. I like this. You have this uptrend right here. This looked like a bullish ABC pattern right here. I got in somewhere in this area right here, and then I put my stop down below here. And so I'm giving this a pretty wide range to bounce back and forth. I think it's going to break out. It's real close to breaking out. When it does, by the way, if you break out of a pattern like this, it's very similar to cup with handle patterns, inverse head and shoulders patterns. They all kind of have the same rule of thumb, which is that when it breaks out, you can take the distance from the top of the correction to the bottom of the correction, and you can project that distance upward. That gives you kind of a minimum target area of where you would expect that stock to go. Now, they don't always go that distance. Obviously, we would need to have more of a bull market condition. Well, there's a good reason to believe this could get there, just because we're moving into the winter months, and Europe's going to need natural gas. But and it doesn't mean it's going to move there immediately. It could move up a little bit, move sideways for a few weeks, and then move up. But that's it. Something doesn't become a rule of thumb if it never happens or hardly ever happens. It happens enough to where you can have some confidence in it. And it, more than anything, it just gives you a visual of where you expect that stock to get to, so you can be patient. You can be patient if it breaks out and then pulls back again, and you can say, okay, it should get up into this area here. It allows you, it's easier to stay in trades when you have at least that minimum expectation that should be going higher. Most of the time it should be going to that area. So that one still looks really good, and I'm kind of looking at the longer term hold on that. Same with Marathon Petroleum, MPC. Again, this looks like an ABC correction through here. I've got my stop down below here. It's breaking out to a higher high right here. So you've got higher low, higher high. Next target you look for is see if it can break out above here. It should at least get there. Whether it breaks out or not, we'll see. But those are my two oil exposure stocks. I've got defense, oil exposure, and then I got stopped out of General Mills, but I might have had my stop a little bit too tight. And I did that kind of knowingly. I got in just, I think on Tuesday, right? I got in this one, and I put my stop just below here. I thought, okay, that looks like an ABC pattern right here. I didn't want to risk a whole lot, but I got to get out. And this one, I should have probably gotten out earlier in the day, but I thought I'd wait till class to do it so I can show you I'm getting out. But the problem is that this could be one I could be right back in, because it could be that this is just in the ABC. As long as it doesn't drop below this low, I probably should have had my stop below this low. That's a better stop loss point. But I think I'd mentioned that too, though, on Tuesday. I thought, well, this one might get stopped out pretty quickly. I didn't give it very much room. So I'm actually going to go ahead and stop out of it. You don't want to get in the habit of saying, oh, well, this is a better stop there. I should have put it here. Okay, let's just lower it down to here. I don't care. I don't mind taking a loss. I do want to have some exposure, though, to the consumer staples sector. So there's another consumer staples stock that I might jump into, and I'll see if I can manage that trade a little bit better. But let's go ahead and stop out of this one. It's at 75.15. Make sure I get the price right, because sometimes the sell price isn't right here. So 75.15. Make sure it's the current price. 100 shares. So look, I'm even though I'm even below my stop, I'm not going to lose very much at $312. That's not bad. Okay, let's go ahead and get out of that one. And then yesterday I added SARK, and that was because we were seeing some selling, a little bit of selling exhaustion here. We had the down candle. This wasn't all the way down to that low, but it tried to rally right here, and it couldn't. It faded. This looks like it could take out. This could be a bullish ABC pattern right here. Now, again, this will probably go down if the market rallies tomorrow off of that jobs report, but I wanted to have some hedge there in case we drop big, because if we drop, we'll probably drop really big. And this thing could go up, and then I'd probably add, if it does drop, especially if it drops below yesterday's low or even today's low, I'll probably add the SOXS in there as well to hedge that a little bit. And that would also hedge the chip stock I was thinking about getting into today. All right, let's quickly look at some individual stocks. Consumer staples is an area you want to have some exposure to. Remember, these are products that you have to buy no matter what the market does, right? You got your grocery store stocks, you're still going to buy food. Anything that is something you're still going to buy no matter what's going on. It's really important that you stay away from consumer discretionary. They are going to get hit hard. Because if you think about it, inflation is coming in, and what's happening right now? You're paying more for gas. You're paying more for food. I've noticed that my food bill is huge, a lot. It's enough to where I notice it. You never noticed it before. It could creep up and you barely notice it, but it's been noticeable. And I know many of you are feeling the same way. What does that mean then? Well, for a lot of people, a large majority of people out there, the middle class, it means that they're not going to have money for that extra vacation this year. They're not going to have money to buy that new TV. They're going to keep the old TV. They're not, even cars. You're going to put off buying cars. They're going to put off buying electric vehicles even. They may want to convert to electric vehicle, but they're paying too much on their food and gas bill to afford it. So those are areas you want to stay away from. Anything that someone can put off. They don't need it right now. because it's only going to get worse until inflation gets reined in, and we don't know when that's going to fully get reined in. And really, inflation needs to start coming down. And so, you do want to have some exposure. Again, I'm not saying load up on these, but there's a reason why a lot of these are looking very bullish right now. We've gone over a few of them over the last little bit. And even General Mills, with the drop it had today, it still looks like it could keep trending upward. This MGPI right here, 97 strength rank. Again, this looks like, here's the trend. This looks like wave A, wave B, wave C. Now you could wait for this to go back to a buy signal as confirmation. If you wanted a more aggressive entry, you could enter now and then put a stop down below here. Here's where you know you're wrong, because that would be the point where that's not an ABC pattern, and now you've got lower highs and two lower lows right there. But that gives you enough wiggle room there for this thing to move around and then see if it continues to move higher. You could wait if you're really just nervous about getting in anything right now. Wait to see if this can break out to a new high. Because, by the way, these stocks, if the market drops, almost everything drops when the market drops. And there's panic selling. People get out of everything. So if you believe that that's going to happen, then, again, even though these stocks have been holding up pretty well and trending pretty good, they will probably come down. Now, maybe what happens is this comes down on a massive sell-off, but it has a higher low. It doesn't go to a lower low. That could be a good bullish confirmation there if that were to happen. But anyway, that one looks pretty good. But the one I like is we're looking under the hold section here. And by the way, what we're looking at is we'd like to look for stocks that are a 90. The main thing you'd like to look for is a 98 strength rank, moving from hold to buy. In these type of conditions, there's not too many 98 strength rank stocks that you're going to see, and so you'd like to see it in the 90 range. And then we'd like to look at the individual chart pattern and see if the chart pattern looks bullish as well. So you have the momentum of the stock showing that it's really strong, and then the chart patterns confirming that. That's what I like to do. Again, you could just go off of the top ones on the list and manage them that way. But once you learn how to read a chart, you'll find that some of the stocks that are high on this list may not be the ones you want to choose, and there could be other ones lower on the list that have great patterns, and they have pretty high strength ranks that might give you a better chance of working out. So we're trying to combine as many things as we can technically to get us into the best trading opportunities. But I like this Archer Daniel Midland. It's a 95 strength rank. But I like you've got this kind of V-shaped move right here. This is more impulsive on this move up. This looks corrective through here. So this looks like your ABC pattern through here. And so I'm going to look to get in. I'm going to put a stop down below here. This is where it still might be a little bit of a tight stop. But this is where I'm probably wrong. If it goes goes below here, goes to a lower low. But this is a company that is heavily involved in wheat, corn, all those food commodities. It's a major player in the food commodity business, and this is an area of potential strong demand. Obviously, you've got Ukraine as being the fourth largest wheat producer in the world that's not producing wheat, at least not as much as it used to because of the war situation. Other farmers are going to have to pick up and make up for that. Companies like this can outperform, and it's a consumer staple. People need food; they're going to keep buying food. The food prices are going up, and so profits are going up when the food prices go up for some of these producers. So that's why you're seeing some of these outperform. So more than anything, I just want to get a little exposure in this area. And again, this is just flip-flopping. I could get the same type of exposure in General Mills, but I got stopped out of General Mills, so I'm gonna get into Archer Daniel Midland and just kind of replace it with this one. Get a little bit of exposure to consumer staples. So I'm gonna put my stop down below this low, which I just rounded it to about $80.50. I'm going to just round that further down to 80. That'll get me down a little bit lower. I don't think it'll make that big of a difference, but let's go over here. You can add it to the portfolio right here. Click on that little blue button. Now, once I put in that stop price, I kind of play around with the number of shares. I usually like to have about 7 to 10,000 in that range in the trade. I try to keep the dollar amount equal in each of these trades I get into. So, 100 shares. 100 shares would be right at 8,600. So that's right in that range. That'd be good. Let's go ahead and stick with 100 shares. I don't get too fanatical about being exactly at 10,000 or something like that. In fact, I've been leaning for the most part to the closer to the 7,000 area, just because I don't want to have too much exposure in the market right now. But we'll just leave that at 100 shares. And then I also look at, based on where my stop is, it tells me what my risk exposure is. And this isn't exact because it's assuming I'm going to get out exactly at $80. And I, like the trade today, I didn't get out exactly where my stop was on General Mills. I lost a little bit more than what I was planning on, but it didn't matter because it was still within my range. And the range is you don't want to have more than 1.5%. I don't want to have more than 1.5% of my total portfolio at risk in a trade. So I want to make sure I'm losing less than 1.5% of my total portfolio. So if it's a $100,000 account, I don't want to lose more than $1,500 on any single trade. Now we're well below that. We're at 0.50 based on that stop. And this is what I would lose if I got stopped out at $80 would be $6.58. Now, another part of this is you better be okay with that a dollar amount. I'm not going to get into it today, but I've talked about in many other classes. You got to be able to accept the risk, and that is different for different people. Some of you are looking at this saying, "Man, if I lost $658, I would be freaking out." Okay, then you got to lower the amount of shares you're getting into until it gets down to an amount that you can handle. But you got to control the risk. Make sure you're controlling the risk as part of this process. I would assume, though, that if you had a $100,000 account, you're putting $8,000 into a trade, that a $658 loss is not going to freak you out too much, or it probably shouldn't. But let's go ahead and purchase. We're going to add that in. One last one in that sector. I got to speed up a little bit here. Sorry. My updates have been getting longer and longer. I need to shorten them. Sorry. I get rambling sometimes, and hopefully the rambles are productive. I don't want to ramble for the sake of rambling, but sometimes I think of something would be a good teaching thing to teach you, and so I go off on it. So hopefully there's some value to it. If it feels like it's too repetitive, let me know, and I'll try to cut out some of the repetitive stuff if I can to shorten up the update. I do need to get it around an hour, though, because it's after an hour, everyone's brains start turning off. And then the CTVA right here, Corteva, 95 strength rank. By the way, on all these, you could wait for it to go to a buy signal as the confirmation to get in as well. Some of these, I like the pattern, so I'm getting in maybe a little bit early. Maybe I should wait until tomorrow even to see what the reaction is. But, and in many cases I would, but I try to do as many of these decisions in class so you can see them. And so it may not be how I would do it in every case in the real world. I might wait until that event takes place and then get into some of these, or decide to get into some of these trades. And you might want to do the same and wait to see what happens tomorrow before you consider some of these. Just because I put something in the portfolio doesn't mean you should put it in yours. That's what I'm saying. It doesn't mean it's guaranteed to work out. It doesn't mean that it's, the magic stock that is going to solve all your problems. As you can see with General Mills, we got stopped out in the very next class. All right, so this looks like a bullish ABC pattern. You've also got this breakout area right here. Again, you could wait for this to break out, especially as close as it is to breaking out. That'd be some pretty good confirmation. Maybe throw it in a watch list and wait and see if it breaks out. Put a stop down below here. That's where you'd probably be wrong. That's a nice pattern right there. And then I mentioned aerospace. Now these, I'm not saying these are just good to put in your watch list, because both of these are sells right now. But Lockheed Martin, they're going to benefit from the whole weapons thing. Let's go to a 1-year chart. So you had this big run up here. This has been just kind of consolidating through here. But if you notice, we've had lower highs, lower lows through here. We broke that, went to a higher high right there. And then it's kind of back to lower highs, lower lows. But we're waiting to see if this is now a higher low from here. Is it starting to, it looks like it's starting to maybe move up the right side of the bowl, so to speak. So I think if this thing continues to rally back up, by the time it gets back to a buy signal, would confirm what I'm thinking here is this thing could be putting in a higher low right here. If it doesn't and it drops lower, you're not in anything. I'm not suggesting you get in this now, but start, put this in your watch list. See if this ends up being a higher low and you start moving to higher highs. I think the other chart was even better on General Dynamics. Oh, it's General Dynamics might have been already in a hold. Let me see. Yeah, here it is right here. A 90 strength rank. And Lockheed Martin, I think, was like an 89 or 88 strength rank. So it's still a little bit below 90. Yeah, here, so you broke this downtrend right here. And you're seeing if that is now a higher low. And if it can start breaking above these highs, that would look a lot more bullish. Looks like it'd be moving up the right side of the bowl. And that would probably happen about when this would go back to a buy signal or close by. Maybe if it does go back to a buy signal before it breaks out of here, you'd wait for it to break out of there. Real quickly here, because there's under computer and technology. I don't want to add too much computer and technology, because a lot of these are consumer discretionary type things. But I like the chart on this on semiconductor right here, 97 strength rank. Nice big uptrend here. This looks like a bullish ABC pattern. It's going to a buy signal today. I'm going to put my stop down below here. Now again, if the market rolls over, chips could roll over. This could drop. But actually, this held up pretty well during that last sell-off. So I'm hoping that even if it does drop, it puts in a higher low. If I get stopped out, I get stopped out. But I like that pattern. I don't want to be loading up on computer and technology stocks, though. But now my stop is going to be at 61 down below here. Actually, I'm going to just put it at 60 to get it a little bit lower. I don't think that'll make that big of a difference. So 120 shares would put me at $8,500 in the trade, right at a 1% portfolio risk. But look, the dollar amount, again, this is important, that I would lose about $1,300 if I'm wrong. I'm okay with that because it fits within my parameters, but you would have to consider something like that. That's too high. You'd want to buy fewer shares to get that amount down to whatever level you can handle. And let's go ahead and purchase that. And then one more in that, and we'll wrap things up. I got to hurry. It's another chip stock in that group, this PI 97 strength rank. Very similar pattern here. That looks like a correction of this move up. It's held up pretty well. The market sold off through here, and it's held up pretty well. You could wait for it to go back to a buy signal as confirmation, put a stop down below there. I wouldn't get into both, though. I wouldn't want to have all that exposure. So if we go back to the portfolio, you'll see again, I've got almost 75,000 in cash. Majority is and really I've got exposure to oil, which is outperforming everything right now. You want to have exposure to oil. I've got defense. Defense has been doing pretty well as far as a sector. I've got consumer staples, and I took a little bit of a chance on a chip stock here. And then I've got my hedge with the SARK. This will go up if the market goes down, and so I could be long. But it's not going to hedge everything perfectly. But I'm assuming that if the market sells off, hopefully energy doesn't pull back too much. And I can always add more of these inverse ETFs. I can add the SOXS. The SOXS is the inverse of the chip sector. So that would hedge my chip stock if I bought this. But this is one that if the market started to drop, this will go up, and I could jump into this, and it'll help offset some losses there in the other areas. All right, that's all I have. Have a great week. See you on Tuesday for the next market update. Bye now.